I just looking through some of your comments. Like all of us, we think more people invested in the market is a great thing. Democratization plus. If it's returned to 8%, as you point out, for 100 years, you need to do it to keep up and to plan for your financial future. You also point out, though, that speculation and gambling returns, speculatory returns are lower and gambling are negative. So what should we think of last week? It was it was good because so many people were involved, or it was bad because it certainly wasn't buy and hold?
Great to see you again, Joe. Look, I think by and large, it had really good elements to it. And then there's also some concerning elements we can talk about. When I was running the New York Stock Exchange, it bugged me that I would extol the virtues of the U.S. equity markets, the envy of the world. And people would say, yeah, but it doesn't apply to everybody. There's a whole bunch of people who aren't really exposed to the equity markets. And that's true. And so bringing on likely tens of millions of traders since the pandemic started, a year ago, is a good thing. And hopefully that brings them into the market and they learn some of the kind of long-term buy and hold investing tenets that have worked so well in this country for over 100 years. And, it can improve lives for a great number of people.
All right, go on. You at the same time, president of the New York Stock Exchange. Did you ever chafe at the way a lot of the Reddit traders characterize the market, the people that run the markets, the people that run the exchanges, the people that run the hedge funds? Without anyone challenging them, they just say, look, we all know it's completely rigged. It's not fair. It advantages people. It advantages the haves, and the have-nots don't have a chance. And this is our time to get back at all this. And if you look at Wall Street, look at any recent polling on Wall Street, it might be below the media in terms of probably not that bad, but think about that, Tom. And you could see a picture of you if we look up in the dictionary who's running things.
Yeah. Hopefully, I'm not one of these suits that we keep hearing about this week.
Well, you love suits. I said that to Andrew that Andrew loves suits. Are we suits?
Yeah, I definitely couldn't wear one today after the branding debacle for suits this week. Look, it's fun to talk about tendies and stonks and all this kind of thing. To me, a more interesting story is probably the less interesting story for the majority of your viewers, which is the clearing infrastructure of the markets. Markets are always going to have short squeezes. They're going to always have kind of panics and manias, and you want to limit those. And the SEC certainly has a fair and orderly markets mission. But the more interesting thing is that the DTCC called Robinhood for $3 billion it didn't have. Take it from me. I've been through this. I've managed clearinghouses. I've managed clearing broker defaults, futures commission merchant defaults. They're a messy business. And in some ways, this was an escape over the last week, and that we didn't have a clearing broker default. Because when you have a clearing broker default, all of a sudden you're liquidating millions of accounts. And I think that's going to be the lasting story. It's that, and then what you described, Joe. It's the perception of the stock markets. And it's interesting because you have a guy coming in to run the SEC, Gary Gensler, who's probably the most knowledgeable SEC chair in history when it comes to clearinghouses. And I expect he's going to gravitate to this issue as well. Walk me through again why you called for $3 billion and they didn't have it, and they ultimately put up a small number. And it's not just Robinhood. There were a lot of clearing brokers getting scary calls last week. And so something broke down in the risk model of the DTCC or in the risk model of these clearing brokers. And I can tell you, having worked with or more accurately for, when he was my regulator, Gary Gensler, there's going to be a whole bunch of insightful, in-depth questions about that.
Shepard Smith here. Thanks for watching CNBC on YouTube.